Good morning and afternoon to all of our viewers. Thank you for joining us today for the ninth episode of the Weekly Wrap by Tech for Fin, where we discuss some of the hottest fintech topics in the news from the past week, along with a new guest joining me every week, and we'll aim to do it in just 15 minutes or less, although we've been bad at that lately. I hope your coffee is ready. Mine is definitely ready here. Let's not waste any more time and get this show going. My name is Jeffrey Tower. I'm the Vice President of Business Development, Channel, and Strategy. Yes, my title has changed at Charged After, and we are the leader in the buy now, pay later platform business. Today's guest is very special to me and close to my heart. I've had the pleasure of working with her and getting to see her raw brilliance up close and firsthand. Please welcome Ornit Shinar, Head of External Innovation and Venture Investing at Citi Israel. Ornit, welcome to the show. Please introduce yourself.
Thank you. Now I've got to blush and everything I'll say after what you said, So as Jeff mentioned, I run External Innovation and Venture Investing. That means we work with startups, trying to help them commercialize within Citi, provide thought leadership to our clients and introduce startups in the fields that are relevant to them. And finally, of course, venture investing. We invest in startups at all stages in areas that are strategic for Citi. It can include obviously fintech, but also cybersecurity, enterprise IT, data analytics, machine learning, prop tech, marketing technologies, you name it. And we're stage agnostic, which means if you have a very early stage startup all the way to a pre-IPO startup, we're interested in seeing you, meeting you, and hearing what you do.
Excellent. So basically, if you have a great idea, speak to Ornit, and we'll tell you how to reach out to her a little bit later. So today's show will be a bit different. We're back from a 2-week holiday break, and we would love to cover some of the items that happened right before our little hiatus. So let's start off with Trigo, an Israeli-based computer vision startup reshaping the retail experience and provides autonomous checkout in retail stores. And they actually raised a whopping $60 million B round to scale their cashierless shopping, and this round was led by 83 North and was followed by our dear friends over at Red Dot, Hertz, Vertex, and a few more. Now, obviously, we all know that touchless payments have been on the rise pre-COVID, but have also become a focal point for fintechs, retailers, and consumers alike since COVID. Now, add on to that the fact that retailers are seeking to have an edge over Amazon. Trigo can be a welcome addition to an alternative to traditional shopping and payments. In fact, according to Juniper Research, more than $400 billion, yes, that is with the B, $400 billion of revenue will be transacted through smart checkout, and that retailers will invest $23 billion into artificial intelligence for retail specific by 2025. So, Ornit, what can you tell me about Trigo and the future of in-store / touchless payments?
So I think it's a very important area. And if you look at what's happened in 2020, it's been one of the largest areas of investment in the fintech space. A fair amount of the investment dollars have gone to anything contactless related during that time. And we can all understand that while COVID was a trigger for this, it's not going to end once COVID is over. I still won't necessarily want to, fumble and touch the money and pass it to people. Why do that when you can do so much better? But sure. To be fair, I haven't been in the super for almost a year now. But prior to that, the number of times I walked into the super, saw the length of the lines, and turned around and left, it's well beyond the contactless payment. I think it's the frictionless payment. Sure. And I think that part in the supermarket may be an even greater benefit than the touchless aspect. It's the fact that I did my shopping, I chose my stuff, I walk out, I don't need to wait for anyone to do anything. Now, when I look at it from an investor point of view, and I try and understand, and not just an investor point of view, right, from a client point of view, and trying to understand what else they stand to benefit and why not use Amazon Go. Amazon is a fantastic company. I think I've probably deserved their gold star for favorite client of theirs, right? But nonetheless, if I were a merchant and I look at what they're doing and how to manage that, the whole point of trying to circumvent Amazon is typically because you want to circumvent the wholesaler. You want to try and get to the consumer right away. Now, the more you go through an intermediary, the more they eat up of some of your revenue, and the bigger that intermediary or the more powerful that intermediary is, the more they can eat up. Mm-hmm. And who's bigger than Amazon these days? So if I were a large corporation, if I could use a technology startup that will take whatever it takes for the technology part, as opposed to having someone who may eat my lunch, start selling what I'm selling, overtake me, because they're a competitor. They're also a retailer themselves. They've got Whole Foods that they've acquired, and they're selling a lot of things exactly in the same manner as I would if I were in the US, for instance, if I were the merchant, right? I'd rather go with someone who's not my competitor, who's not someone who could threaten me in any way. And I think that's what the investors probably saw in this, that it's a third-party, independent alternative that will not be a threat to the merchants and will provide a really fantastic technology that I'm looking forward to this. That if I have to go back to the super, which is a very big point of contention at home, I really would want Trigo to be there.
That's absolutely fantastic, and that makes a lot of sense. And yes, as we all know, or some of us may know, Amazon Go has been in the market since 2016, and it really is interesting to see why investors are starting to pour in so far $95 million specifically into Trigo, when Amazon has been so active in the market, or has been active in the market. But the other thing is that I haven't seen Amazon really go ahead and push out their Amazon Go into Whole Foods, for instance, which they purchased as well. So I wonder where that's going to go. Now, questions. Yeah,
they
right.
usually have very good strategies, so it's definitely one to look at.
Yes, absolutely. So the next item that is something that that's made a little bit of noise lately, not too much noise, just a little bit of noise, and not sure how much people actually know about it. But if you've been driving around Tel Aviv, you might have seen some of the billboards, and we're talking about the Tel Aviv Stock Exchange Up, or Tossup. Now, Ornit, Tossup sounds like another crowdsourcing business to me, but this time it's in the disguise of, or under the umbrella of, the Tel Aviv Stock Exchange. And I may be completely wrong. Now, it might be that, or is it a younger sibling of the popular SPAC, which everybody's been talking about so much lately? What can you tell us about the Tel Aviv Stock Exchange Up?
So maybe I can start by telling you a little bit about the structure of it, and then I'll share some thoughts around that. Yeah. So the first thing I want to, I would say is, what they're trying to provide now is a place where you can IPO a first-time or first VC fund. You may have previous funds, you may be a first-time VC, it doesn't matter, but it's an independent fund that wasn't running prior to that, and you're IPOing it. And the way you do that is that you need to put down about 20-25% of the money that you want for the first closing. First closing could be as little as $5-10 million, probably around 10. So you're putting down a very small initial amount, and you're going to institutional investors, and you're getting them to invest the remainder. Now, once you've done that, you've IPO'd, you can then do second, third, fourth closings, whatever you want. You no longer need to put your hand in your pocket. And the way you can then sell it to your institutional investors is that, as opposed to a regular fund in a public one, you can just buy and sell shares in the fund on the fly. You don't need to wait for an exit. So it gives you additional flexibility.
So, Ornit, let me just ask you a question about that. So Group 11, right, the venture capital fund of the famous investor Dovi Francis, who's part of the Israeli version, the Shark Tank, and the startup company Viv, are the first to join Tossup. And Group 11 is hoping to raise $100 million, and or with their listing, and Viv is looking to raise an additional $50 million. But my question is, why Tossup? Like, why not just go the institutional way? Why not just go directly with the LPs? Why not just go directly with the VCs? What is so attractive? And I'm sure there's something, probably, a story on the backside of that as well. But like, why Tossup? And also, should other entrepreneurs be going that way? Should they be considering raising funds through that platform, or they should be coming in, knocking on your door of Red City?
So these are all great questions, and maybe I can take you, first of all, to why this was set up. So it was set up by the government, I think, as a result of COVID, where there was a real worry that startups would not be able to raise money, and they wanted to provide new means of getting to money in a simpler, faster, easier way, from sources that would otherwise be less prone to investing, perhaps, in these spaces. So it's not crowdfunding like the ones we see on the web, in the sense that, it's not for you or I wanting to buy a product. This is a real fundraising, in the sense that it's accredited investors and larger amounts of money.
Almost like an Our Crowd?
Possibly more like an Our Crowd, yes, than a Kickstarter, right?
Gotcha.
And when you look at it in that way, you're saying, okay, who should go to that versus who should go to something else? Now, let's be honest. My optimum choice, if I have as many VCs as I want throwing themselves at my feet, would be to go to the one that is either has the best reputation or has the best contacts for me, or will give me the best terms and conditions, and probably some mixture of all of the above, right?
Sure.
Will this be necessarily something like Chase? I would imagine that some will prefer that and some will prefer something else. And in the end, most companies don't necessarily have 3 or 4 term sheets thrown at them at the same time, so they'll take what they can get. Now, the big thing in Chase is that, except for the first company where during the initial IPO, you need to actually show information about the first company, all of the other fundraisers don't require any large amounts of information to be disclosed about the company. So the big risk with a publicly traded company is that you need to constantly provide a lot of information. And if we're talking about a young startup, they don't have that much information. Forget the fact that they may or may not want secrecy. They don't have the amount of information that would make it something that's easily tradable and can provide value. You constantly want to show that you're increasing your sales or developing new products. That will create new value, the stock will grow, et cetera, et cetera. Now, when you're going to an IPO like this, and you're not sharing all this information about the shares or the company and how it's progressing, then how will it create value? Now, this is not the first time that VCs IPO. There have been a few other examples, and I've actually gone out and dug out their results. And typically the result is that you can sell the shares if there is enough demand for it, A, and B, it's typically, I was going to say pennies on the dollar. That might be a little too harsh, but it's discounted nonetheless.
Discounted.
So you wouldn't necessarily go that route. Now, perhaps if you have a strong reputation, if you want to try it out, it's a good marketing path. And it might also enable you to go after types of companies that you would do certain types in this type of fund and other types in another type of fund. And as long as it's well differentiated, nobody could claim that there is any thing to-do about having 2 funds that invest in different types of companies. But you would want to be very clear about that you're bringing your best foot forward when you're doing this, and you're bringing the best companies you can that fall within the criteria of that fund that you're raising.
Sure. Well, that's really great insights, and thank you for explaining more about the. How do you call it? Do you call it TASE?
Yes,
that's the right. So I've been calling it TASE, right? Tel Aviv Stock Exchange Up. Now, on to the next part in the last segment of the weekly wrap today, episode 9. As you know, Ornit and I, I've had the opportunity to work with you through the wonderful Accelerator program that you put together, a city put together in Tel Aviv. In fact, I had the privilege of working with 2 companies that graduated the program, and there's been fantastic companies that did graduate the program. And I, of course, put a lot of the success of these companies on, not necessarily on the city as an institution, but on the people that run the programs as well, because it's a personal touch. So, Ornit, tell us more about the program and some of the interesting companies that came out of it. And, tell me a little bit more about what you or what city the Accelerator would be looking for in a company and in an entrepreneur to accept them into this, in my eyes, very exclusive and very successful program.
First of all, thank you for all your big words. Now we're going to have to try and live up to the standards that you're setting here. So we set up the Accelerator in 2013, and when we established it, it was under, I'd say, supported by the Chief Innovation Office, the Innovation Authority today. And we were trying to see how we can create a fintech ecosystem. So we were looking for smart, talented teams with a good idea, whether it was super strategic for city or not, was less critical as long as it was something that is within our know-how, so that we would be able to assist them in a meaningful manner. And we were always very strict with ourselves that if we don't have added value that we can bring, they shouldn't be coming to us. And many companies can teach you how to pitch. Not many companies can provide you insights into what a large financial institution requires. Right. So we're very, very focused on what we were doing. With time, and we, just like any startup, you constantly, or any company, you constantly do, I'd say, A/B testing on what you're doing right, what you're doing wrong, and the market changes and the needs change. So, one morning you wake up and you see that Israel has a thriving fintech ecosystem, and you find out that in order to be able to bring real value, it's nice to be able to tell them what city would think about this, but it would be even nicer to select companies that are actually strategic for city and you're capable of doing something with us. And that's the route we
Absolutely.
went. And so then you don't just give them good advice, you can actually get your hands dirty, roll up your sleeves and try and get them involved with city clients. And that's what we've been doing. And, very, very proud to say that we have over 100 graduates who have raised over $1.5 billion, that these companies are often commercialized within city or within city's clients that we've introduced them to. Very often, we see them through our introductions growing and thriving and going, to many places that make us very proud. People always ask me, so what's in it? Do you get skin in the game? And that's the beauty of it, that we have done this in a manner that we don't demand anything, but we try and invest in the companies that work well. We try and help them in any way we can. And sometimes it's just like a big warm family, and you can see, this guy next to me here feels a bit like family, and we are very caring, I'd say, mutually. We try and help the companies, and companies really look favorably upon us. So there's a lot of good karma that ensues from the program, and it's done phenomenal things that has enabled us to do a lot of interesting programs in which we've done marketing of new ideas or development of new ideas. We've brought up things in areas of cloud or in areas of APIs, but also in things like impact and unconscious bias and things like that. So it really has given us a very strong tool to communicate with the market and try and do great things. We're firm believers that 1 + 1 = 3 when the right minds get together.
Absolutely. And again, I really experienced a fantastic time being in the Accelerator, and brought through 2 different companies through the Accelerator, and we learned a lot, and thank God things are still going strong. So thank you for all of you, all that you do for the Accelerator, and of course for the fintech environment. And again, think about it, 100 different graduates and $1.5 billion invested so far. For companies that went through this Accelerator. Again, not necessarily by city, the investment. There you go. I'm sure legal wants to hear that, right? But
a very small part of that is by us directly.
But fantastic work, and of course, you guys are definitely a vehicle for the success of so many different companies in the industry. So that is it. That is time. Thank you, everybody, for joining us today for episode 9 of the Weekly Wrap by Tech for Fin. Ornit, thank you so much for joining us today and for sharing your wonderful input on the hottest topics in the fintech news. And please make sure to join us next week for episode 10. I will have to use some more fingers. We'll see. Maybe I'll use my toes. Anyway, same place, same host, and a new guest. Thank you guys so much. Jeffrey Tower, stay safe and be well.
Thank you.